Let me ask you something honest. When your paycheck hits your account, what do you actually do with it? Most people pay their bills, buy what they need, maybe save a little, and whatever is left just sits there. And that is completely normal, because nobody ever sat most of us down and explained what to actually do with money. Not in school, not at home, not anywhere. So today we are going to fix that. From the very beginning, from zero, we are going to talk about every single place you can put your money, what each one actually is, how it actually works, what it actually returns, what can go wrong, and how long it actually takes. By the end of this video, you will understand more about investing than most adults walking around right now. Let us start. First, before we talk about any investment, you need to understand one thing. It is called inflation. Inflation is simply the rising cost of everything over time. Think about this. 30 years ago, a movie ticket in America cost around $5. Today, that same ticket costs around $15 to $20. The movie did not get 3 times better. The dollar just got weaker. Right now in America, the official inflation rate is 2.4% per year. That is the most recent number confirmed by the United States government. That means everything you buy costs about 2.4% more every year. And here is why that matters for your money. If your money is just sitting somewhere, not growing at least 2.4% per year, it is actually losing value, not in numbers, but in what it can buy. So when we talk about any investment, the first question is always, is this beating inflation or not? Keep that in your mind as we go through everything. Okay, now the first place most people put their money, the regular savings account. Let us understand what this actually is. A savings account is simply a place at a bank where you store your money safely. The government protects your money up to $250,000, so it cannot disappear. The bank takes your money, uses it to give loans to other people, and pays you a small percentage as a thank you. That percentage is called the interest rate. Right now, the average regular savings account in America pays you around 0.6% per year. 0.6%. So if you put $1,000 in today, after one full year, you get back $1,006 extra. Meanwhile, remember inflation is 2.4% per year. So your $1,000 needs to grow by $24 just to keep up with rising prices. But it only grew by $6. That means you actually lost buying power. Your money looks the same on paper, but it can buy less in real life. A regular savings account is not an investment. It is a parking spot. Use it to store your emergency fund. Use it for money you need within the next few months, but never use it to build wealth. Now here is the smarter version, the high-yield savings account. This is the same thing as a regular savings account. Same safety, same government protection, same easy access to your money. The only difference is the interest rate. Right now, the best high-yield savings accounts in America are paying anywhere from 4 to 5% per year. That is more than 6 times better than a regular savings account. So that same $1,000, after 1 year in a high-yield savings account, gives you $40 to $50 extra instead of just 6. And that actually beats the 2.4% inflation rate. So your money is genuinely keeping up with inflation, instead of quietly falling behind it every single day. High-yield savings accounts are usually offered by online banks. They have lower costs than big traditional banks, so they pass those savings to you as higher interest. If you have money sitting in a regular savings account right now, moving it to a high-yield savings account is one of the simplest, smartest things you can do today. No risk, just more return. Now let us talk about something people have trusted for thousands of years. Gold. Let us understand what gold actually is as an investment. Gold is a physical metal. There is a limited amount of it on Earth. You cannot print more of it. You cannot create it out of thin air. And because of that, its value tends to hold and grow over time. When everything else in the economy is falling apart, when people are scared, when governments are printing too much money, gold tends to go up. Think of it like this. If the entire financial system got wiped out tomorrow, paper money might mean nothing, but gold would still have value. It always has throughout all of human history. Now let us look at what gold has actually done recently, because this is where things get extraordinary. Around 2 years ago, gold was trading at around $2,300 per ounce. Today, in April 2026, gold is trading at around $4,600 to $4,700 per ounce. That is more than double in just 2 years. And in 2025 alone, gold hit over 50 all-time highs in a single year and returned over 60% in just 12 months. That kind of performance is almost unheard of. But here is something important to understand. Gold does not always do this. It moves in cycles. It does not pay you any income while you hold it. No monthly payments. No dividends. It just sits there. And its value can drop too. In 2013, gold dropped nearly 28% in a single year. So gold is not a safe guaranteed return. It moves based on fear and uncertainty in the world. The smart way to use gold is as protection. A shield against chaos. Something that holds value when everything else is falling. Most long-term investors keep around 5 to 10% of their money in gold. Not everything. Just enough to protect what they have built. Now let us talk about something that has made more American families wealthy than almost anything else in history. Real estate. Real estate simply means property. A house, an apartment building, piece of land. There are 2 ways real estate makes you money. The first is appreciation. That just means the property becomes worth more over time. Historically, American real estate has gone up, around 4% per year on average. So if you bought a home worth $300,000 today, in 10 years at 4% growth per year, that home could be worth around $440,000. You made $140,000 just by owning it and waiting. The second way real estate makes money is rental income. If you own a property and rent it to someone, they pay you every single month. Good rental properties in strong markets can bring in 6 to 10% of the property value per year in rent. So combine appreciation plus rental income, and real estate becomes one of the most powerful wealth builders available. But here is what makes real estate different from everything else. It requires real money to get started. You need a down payment, usually around 20% of the property value. On a $300,000 home, that is $60,000 upfront, plus closing costs, plus repairs, plus property taxes. And unlike stocks or gold, you cannot sell real estate quickly. If you suddenly need cash, you cannot sell a house in a day. Real estate rewards people who are patient, who have capital to start, and who are willing to play the long game. But for those people, the rewards are generational. And now, the big one, the stock market. A lot of people are scared of the stock market. And honestly, that fear makes sense, because nobody ever explained it properly. So let us do that right now. When a company wants to grow, needs money, one way to raise that money is to sell small pieces of itself to the public. Those small pieces are called stocks or shares. When you buy a stock, you are buying a small ownership stake in that company. If the company does well and grows, your piece becomes worth more. If the company struggles, your piece becomes worth less. Now, instead of picking individual companies, which is very risky, most smart regular investors put their money into something called an index fund. An index fund is simply a collection of hundreds or thousands of companies, all bundled together into one investment. So instead of betting on one company, you are essentially betting on the entire American economy. And here is what the entire American economy has done over time. Over the last 100 years, the American stock market has returned, an average of around 10% per year. 10% every single year on average. Now let us talk about what that actually means with a real example. If you invested just $100 per month starting at age 25, and left it in the stock market until age 65, a 10% average annual return, you would have over $600,000 from just $100 a month. That is the power of something called compounding. Compounding simply means your returns earn returns. Your money grows, then that growth grows, then that growth grows again. Over decades it becomes something extraordinary. But here is the part that scares people. The stock market is not a straight line up. Some years it drops hard. In 2008, during the financial crisis, the market dropped nearly 40%. People who had $100,000 in stocks suddenly saw $60,000 on paper. That is terrifying. But here is what happened next. Within a few years, the market fully recovered, and then kept going higher. In 2020, when the pandemic hit, the market dropped 34% in just 1 month. And then within 6 months, it recovered completely and went on to hit all-time highs. Every single drop in 100 years of American stock market history, every single one, has eventually recovered and gone higher. The people who lost money permanently were the ones who panicked and sold when prices dropped. The people who stayed in, who held on through the fear, came out significantly ahead every single time. The risk of the stock market is not the drops. The drops are temporary. The real risk is your own emotions, the fear that makes you sell at the worst possible moment. Now there is one more thing that most beginner videos never mention, and it is extremely important for anyone in America. Tax-advantaged accounts. When you invest money through a regular account, the government takes a percentage of your gains as taxes. But America has special accounts that either reduce your taxes now or eliminate taxes on your gains completely. The two most important ones are the 401k and the Roth IRA. A 401k is a retirement account offered through your employer. You put money in before taxes are taken out. That means your taxable income goes down right now, and your money grows without being taxed every year. Many employers will also match a percentage of what you put in. That is essentially free money, and most people never take full advantage of it. A Roth IRA is an individual retirement account you open yourself. You put money in after taxes. But here is the incredible part. When you retire and take the money out, you pay zero taxes on all the growth. The current contribution limit for a Roth IRA is $7,000 per year. If you put in $7,000 per year starting at age 25, and it grows at 10% per year until you are 65, you would have over $3 million, completely tax-free. $3 million from $7,000 a year, just by starting early and letting time do the work. These accounts are one of the most powerful wealth-building tools available to regular Americans, and they are almost never explained simply. So now let us bring all of this together. Every investment we just talked about has three things: return, risk, and time. A regular savings account gives you 0.6% return, almost no risk, works for short-term needs only. A high-yield savings account gives you 4 to 5% return, almost no risk, works for short to medium-term needs, and actually keeps up with inflation. Gold has delivered extraordinary returns recently, over 60% in 2025 alone. Medium risk over time, works best as protection over medium to long periods. Real estate gives you strong combined returns from appreciation and rental income. Medium risk, if done right, requires long time and significant upfront capital. The stock market gives you the highest long-term return historically, around 10% per year on average over 100 years. Higher short-term risk, but over long periods the risk drops dramatically. And tax-advantaged accounts like the 401k and Roth IRA let you keep more of what you earn by reducing or eliminating taxes on your investment gains completely. Now here is the honest answer to where you should put your money. It depends on where you are in life. If you are young and have decades ahead of you, put more into stocks inside tax-advantaged accounts. Time is your biggest advantage. Use it. If you are getting closer to needing your money, shift more into safer options like high-yield savings. Always keep 3 to 6 months of living expenses in a high-yield savings account as your emergency fund. Never invest money you might need tomorrow. Keep a portion in gold as protection, around 5 to 10% of whatever you invest. And if you can get into real estate, do it. Be patient, be prepared, and hold long-term. The secret is not picking one and ignoring the rest. The secret is understanding all of them and using each one for what it is actually good at. That is not complicated. That is just the truth nobody took the time to teach you. Until now. If this video gave you something real, something clear that you never had before, hit that like button. Every single week we go deeper into the psychology and the truth behind money, the real stuff, the stuff that changes how you think and how you live. Subscribe and come back next week. I will see you there.